Let's work exercise 20.6 from chapter 20 on leases. So as we can see in exercise 20.6, we're going to work lessor entries, sales type lease with option to purchase. So as always, let's set up the problem, note the facts, and then we'll work through the requirements. So Castle Leasing Company signs a lease agreement on January 1st, 2025 to lease electronic equipment to Jan Way Company. The term of the non-cancelable lease is 2 years, and payments are required at the end of each year. And then we have 4 facts related to the lease agreement. So let's note some things here. So the date of the agreement is 1/1/2025. Let's see, it's non-cancelable. Let's see, we can also note that the term is 2 years. And payments are required at the end of each year. So that's a little different than most leases where you pay up front. In this case, the payments are made at the end of each year. So there'll be 2 payments made at the end of year 1, December 31st, 2025, and the second payment at the end of year 2, December 31st, 2026. And then we have some additional information. Point number 1. So Janway has the option to purchase the equipment for $16,000 upon termination of the lease. It is not reasonably certain that Janway will exercise this option. So there's a purchase option, but it's not expected that Janway, the lessee, will actually exercise this option. So it does not appear that this is going to be a bargain purchase option, but there is a purchase option, so we'll note it. Number 2, the equipment has a cost of $120,000. Let's note these facts. That is a fair value of $160,000. The life is 2 years. And the residual value is $16,000, which coincidentally matches the purchase option. So therefore, we can eliminate this being a bargain because the value of the equipment at the end of the 2 years is expected to be $16,000, and they can buy it for $16,000. That's not necessarily a bargain. So number 3, Castle Leasing wants to earn a rate of return of 5% on its investment. Let's say so. Castle desires rate of return of 5% on its investment. So if it's going to do this deal, it wants to make a 5% return on the lease arrangement. Number 4, collectibility of payments by Castle Leasing is probable. All right, so there's our facts as we understand them from the problem. Now let's see what we're required to do. Part A, prepare the journal entries on the books of Castle Leasing to record the payments under the lease and to recognize the income for the years 2025 and 2026. Okay, before we go into that, we first need to decide what type of lease this is for Castle. So we are the lessor in this example. Therefore, we're Castle Leasing Company. So let's decide if this is a capital lease that's going to be recorded as a sales type lease, or is this a more basic operating lease? So we've discussed the bargain purchase option, and we don't see that present in the facts. Next, let's look to see if the present value test exceeds 90% of the value of the asset. All right, so let's and while we're at it, we need to calculate the payment. So let's kill 2 birds with 1 stone. So let's calculate the annual payments. And we'll determine what the present value of that is as we calculate it. Okay, so the fair value of the leased asset, we need to find that amount, and that was given to us in point number 2. It says that the fair value of the asset is $160,000. We are going to subtract out the present value of the residual value. Okay, so the residual value is $16,000, but that's in 24 months, 2 years from now. So we want to know, well, what is the present value of that today? So let's calculate that. So we'll use Excel to calculate the present value. We were given that this is a 5% return. So the rate is 5%. The number is 2 years down the road. It is not a payment. It's a future value of 16,000. So what's the present value of that today? 14,512. So if we subtract that out, assuming that we've got to think about what is Castle going to have for cash flow? They're going to receive 2 rental payments at the end of each of the 2 years, December 31st. And then they're also going to be left with a $16,000 asset that they can sell. Janway can purchase it for $16,000 based on point number 1, or Castle can sell it to somebody else. It'll have a value of $16,000. So they should get a $16,000 cash flow at the end of 2 years when they dispose of the asset, either selling it to Janway for $16,000 or selling it to another party. So that present value of that $16,000 is $14,512. And so the remaining cash flow has to be allocated to the rent. And that is going to be the difference between the fair value of the asset at the date of the lease minus the present value of the purchase option. The residual value, 16,000, present value was 14,512. So if we net those together, we get that the lease payments are 145,488. Now we need to find the present value of that. We'll calculate this using the payment formula. All right, so we're going to have a payment. It's going to have a rate of 5% again. There are going to be 2 of them. And the amount we know is the amount to be recovered through the leases. And so that's going to be 145,488. So if we calculate that amount, it'll into our formula we are shown. Let me change that to a positive number there. So again, the formula that we used is the 5% interest for 2 payments. So we're calculating an annuity, but it is not annuity due. So let me confirm that here, that it is not an annuity due, because we make the payment at the end of the period. And the amount that the present value amount that we're calculating this based on is the 145,488. Again, that's the amount that's going to be recovered through lease payments. And so we're trying to figure out, what are those 2 lease payments going to be? They're going to be $78,244 a piece. Okay, so we've got a lot of information here. I will pause for a quick second to allow you to pause if you need to and rewatch this section. Okay, given what we know about this lease now, we do know that the present value of the payments is $145,488. And so then our question is this greater than 90%? So let's do the 90% economic value test. And our present value, 145,488, divide that by the value of the asset, and we get a percent of 90.93%. So this is in excess of 90%. So therefore, this test confirms a sales type lease arrangement. Okay. So now we know how a sales type lease agreement. Another item that we know, it's a 2-year lease, and the life is 2 years for the asset, which is 100% of the asset's life. So that also triggers a sales type lease. So we don't have a bargain purchase option. We do not know if it's specialized. We don't know if title transfers at the end of the lease. I'm assuming it does not, since it says that there's no mention of that in the problem. It's not a bargain purchase option. However, the economic test of 90% is met, and the useful life test of 2 years over a 2-year lease also meets the definition, the requirements for a sales type lease. So now we know what kind of lease we have. Now we're ready to work through a problem. So for part A, prepare the journal entries on the books of Castle to record the payments received under the lease and to recognize the income for the years 2025 and 2026. Let's begin by setting up a table. So we'll have Castle Leasing, and in our case, we are the lessor. We're asked to do everything for the lessor. So we'll set up the lease amortization schedule. And the columns we need the date, we'll need the annual lease payment, we'll need the interest on the lease receivable, the recovery of the lease receivable, and then the carrying balance of lease receivable. We'll fix some formatting here so we can see all that. All right. So there's our columns that we'll need to set up this lease receivable. Lease amortization schedule, rather. Okay, so our date, we know our lease begins on January 1st, 2025. So we'll start with that date. There's no lease payment that's made that day. There's no interest that's recorded. There's no recovery of lease receivable yet. So we're setting up, though, the lease receivable, which is $160,000, which is the value of the asset. And then 1 year goes by, and we are going to collect our first lease payment. And we calculated that above to be $78,244. So our first lease payment is $78,244. The interest on that is the carrying amount of our lease receivable for Castle, which was $160,000, and they want a 5% return. So we'll calculate $160,000, which was the value of the lease receivable outstanding since January 1st. And we're going to put these in journal entries in a minute, all the way through December 31st, when finally Janway makes a lease payment at the end of year number 1. And so during that time, as we noted, Castle wants to earn 5%. And so that's $8,000. Then the recovery of the lease receivable will be the difference between the payment, what was allocated to interest. And so $78,244 minus the $8,000 that's allocated to the interest on the lease leaves us with $70,244, which is the reduction of the lease receivable. So lease receivable was $160. Subtract out the amount that is allocated to the lease from the payment, leaves us with $89,756. And then year 2026 comes along. And Janway makes another payment, $78,244. The amount that is allocated to the interest, again, the carrying amount since January 1, 2026, all the way through December 31, 2026. The outstanding balance of the lease is $89,756. And multiply that by their interest rate, which we were given earlier in the problem, 5%, results in interest on the lease of $4,488 for 2026. As we did before, calculate the annual lease payment minus the amount that's allocated to interest. Will give you the amount that's recovered for the lease receivable. And we'll adjust the lease receivable, just like we did in the previous year, 89,756 minus the amount that's attributable of the payment to the recovery of the lease, leaves us with $16,000. Now that should be obvious. That 16,000 is the residual value of the asset. So our last row here, if we do assume that Janway makes the purchase, or we Castle sell the asset, we should get a $16,000 cash payment. There's no interest because there's no passage of time between these two lines. They're the same day. And then the recovery of the lease would be the 16,000. And if we do our calculation where the prior balance minus the current payment is going to leave us with $0. So now we have our amortization schedule set up. If that's not totally crystal clear, let's work through the journal entries and see if that doesn't help solidify the transactions. So A, prepare the journal entries for Castle to record the payments received under the lease and to recognize the income for the years 2025 and 2026. On January 1, 2025, they will debit the lease receivable, and that amount is going to be the future value of all the, or not so much the future value, let's get this terminology correct. It's the fair value of the leased asset. There's the outcome of this asset is there's two payments of $78,244, plus there's a $16,000 residual value at the end of the 2 years. And so the fair value of this asset that they're actually, in this case, it is a sales type. So the fair value is $160,000. Therefore, they're going to record the lease receivable as $160,000. We will then also debit the cost of goods sold. We'll have a credit to sales revenue and a credit to inventory. It said in the problem that the equipment, and comment number 2, the equipment cost $120,000. Therefore, we, Castle, we have this inventory, this asset on our books for $120,000 that we are entering into a sales type lease. So therefore, this is no longer equipment that we're available to sell. So we will credit inventory by $120,000. Our sales revenue, we did calculate that up above. We're not going to take the revenue on the we're not going to take the revenue on the 16,000. We're going to look at the total amount that we expect to collect because of the lease. And that amount, so the fair value of the asset was 160, then there's the 16,000, the present value of that related to the residual value. We're going to ignore that to find sales revenue. And our sales revenue is going to be the amount that we're going to actually collect because of the lease. And that's $145,488. 145,488. And the difference will be what is cost of goods sold, which let's do this as a calculation so you can see where this is calculated from. So we know that the inventory has a $120,000 cost to us. However, we are still going to have $16,000 at the end. So the cost of goods sold today is going to be reduced by the $16,000. So minus the present value, well, or we already calculated that amount. It's right here. 14,512 is the present value of the residual. And because that's a negative number, I will show it as a negative number. So it will be $120,000 minus 14,512, and that equals $105,488. So if we look at our debits, we have debits of $265,488 and credits of $265,488. We've got the entire amount of our lease receivable. We've carried the entire amount of the inventory, relieved inventory. The cost of goods sold is the amount of inventory minus the present value of the residual value, which was $14,512. And then the sales revenue is the amount that's allocated to the lease payments, which is amount to be recovered through lease payments, $145,488. So, and that does match this. January 1st is matching to this line for the lease receivable of $160,000. This matches this. Okay, so that's the date the lease is initiated. And then on December 31st, 2025, we receive our first payment. And so we will have a debit to cash. And our debit to cash, as we found earlier, is $78,244. And then we will have a credit to the lease receivable of $70,244. We've already calculated that in our table. And then a credit to interest revenue because we're carrying a finance type lease, sales type. And that's the other 8,000. And then another year goes by and we get our second lease payment. So we'll debit cash. So we go to our schedule, we get $78,244 in cash. And we will credit lease receivable. And that amount is $73,756. And also credit interest revenue for year number 2. And that is $44,488. So if we were to put a T account together, let's do a T account real quick for lease receivable. I want to see what is going on inside of this account. All right. So we will set it up here. Okay, so there's our T account for lease receivable. The first amount entered is a debit of $160,000 from January 1st, 2025. So this is at lease initiation. We recorded a debit of $160,000. And then during 2025, we have December 31st, we have a credit to lease receivable of $70,244. So we record a credit. And so this is related to the payment at December 31st, 2025. A portion of that payment went to interest, $8,000, and the remaining amount, $70,244, reduces the lease receivable. So our lease receivable balance at the end of 2025 is $89,756. So this is the balance at 12/31/2025. And we can confirm that off of our schedule we did earlier, $89,756. And then year 2 came around and we made another payment. And this time, credit to lease receivable is $73,756. What's our balance now? It's the $16,000, and that's the residual value. So right now, after the journal entries we've made before, for Part A, we have a carrying amount of the lease receivable of $16,000. And that does confirm to our schedule right here. the $16,000 is the balance of the lease receivable at December 31st, 2026. However, we still have to deal with the asset that has the residual value of $16,000. So let's read Part B. Part B says, assuming that Janway exercises its option to purchase the equipment on December 31st, 2026, prepare the journal entry to record the sale on Castle Leasing's books. Okay, so if Janway does decide to keep the equipment and they're going to purchase it, they owe $16,000. So that's going to be a debit to cash of $16,000. And then the asset that we don't have the asset anymore because we took the asset off the books at January 1st. So the inventory is gone. So the only asset we have left is this lease receivable. And we can confirm that, yes, if I credit that by $16,000, because the lessee purchased the asset, what is that now? The balance related to this lease should be zero. And it is. By recording the journal entry in B, so this part is B, where the lessee, Janway, decides to purchase the asset at the end of the lease. They decide to keep it. And the document said in part number 1 that they had the option to purchase the equipment for $16,000 at the end of the lease. And they decided to do that. We didn't know at the beginning that they would do it, and there was nothing that said that the $16,000 was a bargain. So therefore, we had to wait and see what happens at the end of the lease. And we did confirm that they actually did that. Okay, at this point, this does conclude the example to solve exercise 20.6 related to sales type leases and the journal entries for the lessor.